In this week's I Hate Numbers video, I'm going to be covering inheritance tax. Now, it seems potentially quite a morbid topic to cover, but we need to address it. I'm going to be looking at what actually is inheritance tax, the concept of what's called transfer of value, and that's fundamentally what inheritance tax is based on, how much is actually taken, and this week's video is about laying the parameters, the framework for inheritance tax. Now, we know the two certainties of life that we can't avoid and we know we have to deal with at some point is death and taxes. And inheritance tax is the combination of those two events. Now, it can feel quite daunting. It can feel quite like an ominous shadow lurking over your shoulder, especially when you're dealing with the emotional challenges of losing somebody close to you. Now, it doesn't all have to be doom and gloom, however. And with good, effective planning, it is possible to mitigate, if not avoid completely, inheritance tax. Now, in this week's video, I'm going to be looking at inheritance tax through the lens of a simple concept which underpins inheritance tax, and that's called the transfer of value. Let's assume an individual has what's called an estate, and don't think rambling great big houses, Jordan houses, lots of land. Everybody has an estate of some description. An estate is just a collective term for anything that you have of value. So it could be money in the bank, it could be household furnishings, it could be money you've invested. So tax is on the estate. Now, there are two events that will happen. You have an estate, and for most people, they look at the estate when they pass away, the value when they die. Now, that estate is made up of money, possessions, as I said, a variety of assets. It could be stocks and shares, it could be your business, it could be your family home. All those things here constitute the estate itself. Now, for most people, the relevant impact on IHT kicks in when they pass away. So if you've got collective assets of, say, £1 million, when you pass away, that's the value of your estate. You have a inheritance tax threshold, currently $325,000. Anything over that, the default reaction is you're subject to tax on that at 40%. And that's a very simplistic overview. However, inheritance tax applies not only on death, but it potentially gives us opportunities during our lifetime to transfer some of that value away and actually take advantage of exemptions. So there are ways to mitigate that tax bill, which I'm going to touch upon later on. Let me reinforce this idea of transfer of value. Now, let's assume you have something, you've got an orchard, an apple tree, a fruit tree of some description, and over the years, you've nurtured it, the apple tree grows, it becomes much more fruitful, and you've got apples there aplenty. Now, if you pass away, then all that fruit on the apple tree becomes your estate, becomes your bounty. If somebody then takes that off you, that's the value you're transferring to them. But you can actually allow people to pick that fruit, to take that bounty off that tree during the time that you're alive. Now, when we apply that to the context of an individual who's got an estate, any transfers of value that you have during your lifetime aren't taxed for inheritance tax immediately. There is a saying, the idea that if you can survive the transfer of that gift, you're giving cash away, giving money to your relatives, friends and family, at that point, you don't pay the inheritance tax. If you survive that gift for 7 years, then that completely drops out of your inheritance tax, and therefore potentially that will reduce your inheritance tax bill. If you survive that gift for at least 3 years, by the way, then you start to reduce the amount of inheritance tax that you pay. When somebody dies, when somebody passes away, for inheritance tax purposes, we look to see what they have when they've passed away, and then we look to see what they transferred in that 7-year window. That's how the essence of inheritance tax works. Now, how much is taken? Well, the government slice, the government cut from that orchard that you're growing is 40% as a default number on the value of your estate above that threshold of £325,000. Now, I'm going to share with you some things that you can do to mitigate and reduce that inheritance tax bill as well. Now, obviously, if you add up the value of your assets, the family home I'm going to deal with in a few moments, then if it doesn't exceed £325,000, then you have nothing to worry about. That £325,000, by the way, folks, is for you and your wife, your husband, your same-sex partner. So if you're in a same-sex marriage, that also counts for you. And you can transfer that allowance, that anything that's not used, to your spouse in the event of your death. And as I said, there are ways to mitigate and reduce that tax bill. So for example, if you leave everything to your spouse or civil partner, there's no inheritance tax to pay at all on that first transfer. Any part transfers, by the way, potentially comes in inheritance tax now. It's like somebody else taking over, looking after that fruit tree for you when you've gone away. So as a minimum, make sure you've got that will, make sure you've got that agreement where you pass everything over to your surviving spouse. Now, in addition, family homes get a special treatment, and there's something called a residence nil ban. Is that a bit of a mouthful? Now, what that means is that's an additional allowance that applies if you're passing on your home to your children or your grandchildren. Now, the £325,000 that I mentioned earlier on can go up to £500,000. So when we look at the estate, those assets that you've collected, offset by any debts, then the family home attracts a higher value. So for a couple, that's a collective £1 million. Now, there are other ways to reduce your inheritance tax bill, and I'm going to share a couple of those with you right now. You are allowed to make gifts out of your estate up to the value of £3,000 per year. It's called an annual exemption. It may not sound significant, but those gifts that you make will effectively start to reduce the value of your inheritance tax estate, and that's fantastic. So my advice would be, as a purely generic thing, and make sure you seek that professional advice. The sooner you can give your capital away, pass that over to your family, maybe your friends, whoever you want to give that to, then the easier you diminish the value of your estate. Make sure, obviously, you've got enough to survive on. Now, if you give too much away, too close to at least that 3-year window here, remember, even if you've given something away, and assuming you get no benefit out of that gift, then that still becomes part of your estate if you haven't survived it for at least 3 years. 7 years, by the way, is the absolute deal breaker. If you survive that gift for more than 7 years, then it drops out of your estate and there's no inheritance tax to pay. Now, people talk about things like trusts, and trust can be a real powerful way to do that. That changes things slightly, but trusts, annual exemptions, having a good lifestyle, you starting to spend that money, will also chip away at the inheritance tax liability. Now, what's the answer, folks? Well, the answer is make sure you speak to your accountant, you speak to your advisor, you speak to anyone who's competent to give you advice on inheritance tax. Think about that before that date arrives and it's too late to do anything about it. Now, remember, fundamentally, inheritance tax is that transfer of value. So like passing on what you've built up to the next generation, if you still retain that, then the value will be based on what you've got left over when you die. If you start giving things away and you manage to survive that period of time that we mentioned earlier on, then that will drop out of your estate value. The key thing is to analyse where you are now, to get good, competent advice, and to do the assessment before it's too late. You don't want to be passing that big tax bill on to your beneficiaries, to your family, to have to deal with it itself. Now, this, folk, by the way, is just the basics of an inheritance tax, but it is an avoidable tax if you plan ahead. And there are many more ingenious ways that you can adopt to mitigate, reduce, if not completely avoid, having to pay inheritance tax. Folks, I hope you got some value out of this video. And again, death is a scary thing. Taxes are a scary thing. Don't leave it too late. Have that conversation with your advisors and make sure you plan to avoid inheritance tax. Until next time.